Is the petrodollar dying, or is it being quietly strangled behind the scenes? For decades, the global economy has rested on an invisible agreement. Oil is priced in US dollars, and in return, the dollar becomes the bloodstream of global trade. That system funded American power, stabilized markets, and shaped geopolitics from the Middle East to Latin America. But today, cracks are spreading, and Venezuela may be where those cracks finally turn into fractures. The petrodollar isn't just a technical detail for economists. It affects inflation, interest rates, sanctions, military power, and even how easily governments can print money without consequence. When oil flows in dollars, the world must hold dollars. When that assumption weakens, the entire financial hierarchy starts to wobble. And right now, Venezuela is back at the center of the story. After years of sanctions, collapse, and isolation, recent U.S. actions around Venezuelan oil infrastructure and exports have signaled something bigger than regime change or humanitarian concern. They point to a strategic scramble to secure energy flows, manage prices, and defend dollar dominance at a moment when rivals are openly challenging it. China, Russia, and parts of the global south are experimenting with oil trades outside the dollar. Energy markets are fragmenting, supply chains are politicized. What once felt permanent now feels negotiable. This video isn't about conspiracy or collapse fantasies. It's about power, incentives, and unintended consequences. To understand where the global financial system is heading, we have to start here, with oil, money, and a country that refuses to stay irrelevant. Venezuela may not end the petrodollar alone, but it may reveal how fragile it has already become to everyone. For most people, the petrodollar sounds like an abstract theory, but its origins are surprisingly concrete. In the early 1970s, the United States faced a crisis of confidence. The gold standard had collapsed, inflation was rising, and the dollar needed a new anchor. That anchor became oil. After the 1973 oil shock, Washington struck a quiet but transformative deal with Saudi Arabia, later extended across OPEC. The agreement was simple and powerful. Oil would be priced and sold exclusively in US dollars, and in return, the United States would provide security guarantees, military support, and access to its financial system. From that moment on, energy and the dollar became inseparable. The popular belief is that this system was automatic and permanent, as if the dollar naturally deserved its role. The hidden truth is that the petrodollar was never inevitable. It was a geopolitical arrangement, held together by trust, power, and shared interests. And like all political systems, it was vulnerable to shifts in alliances, wars, and incentives. But while it lasted, the leverage was extraordinary. Because every country needed dollars to buy oil, global demand for U.S. currency remained constant. This allowed the United States to run massive deficits, finance wars, and expand its financial markets without triggering the kind of currency collapse that would cripple other nations. Even more powerful was the weaponization of access. Control the dollar system, and you control trade settlement, banking access, and sanctions enforcement. The petrodollar didn't just fuel cars and factories, it fueled American influence over the global economic order itself. That foundation explains why any challenge to oil pricing threatens far more than energy markets alone and reshapes global power balances overnight. Venezuela sits atop a remarkable contradiction. It holds the largest proven crude oil reserves in the world, about 303 billion barrels, surpassing Saudi Arabia and making up roughly 17% of all known oil beneath the Earth's surface. Yet despite this staggering resource wealth, its actual oil production has cratered to a small fraction of its capacity, barely contributing to global supply. 2 decades ago, Venezuela routinely produced upwards of 3 million barrels per day, a major exporter with deep ties to global markets. Today, output hovers around 800,000 1 million barrels per day, largely because years of political turmoil, mismanagement at its state oil company PDVSA, and international sanctions have crippled investment, infrastructure, and technical expertise. This is where the paradox becomes most stark. A nation so rich in oil, yet so poor in realized production and economic stability. Poverty and hyperinflation ravaged everyday life, even as crude sat in the ground, underscoring how resource wealth without functional governance can become a curse rather than a blessing. In response to U.S. sanctions that restricted dollar-settled oil exports, Caracas experimented with alternative currencies, selling limited barrels in euros, Chinese yuan, and barter deals throughout the 2010s and early 2020s. These efforts were partly born of necessity, but they also represented a political signal, a push against the dollar-centric trading system that underpins global energy finance. Analysts saw it as a small yet symbolic contribution to broader de-dollarization trends, especially among countries seeking autonomy from traditional Western financial structures. Yet the reality remains sobering. Without massive investment and political reform, Venezuela's oil dream will continue to lag behind its geological promise. The world watches not just because of the reserves themselves, but because the Venezuelan story highlights a central tension in modern geopolitics. Who gets to control energy wealth in an age of shifting currency power and competing global alliances? In late 2025 and into early 2026, U.S. actions toward Venezuela escalated from economic pressure to full-on strategic intervention, marking a turning point in the complex saga of oil, power, and global finance. What began with a naval blockade and the seizure of sanctioned oil tankers in the Caribbean, part of Operation Southern Spear, evolved into a dramatic military raid that resulted in the capture of Venezuelan President Nicolas Maduro by U.S. forces. The official U.S. narrative framed these moves as necessary to combat narcotics trafficking, corruption, and regional instability. But beneath that rhetoric lies a clear geopolitical strategy. By asserting control over Venezuela's oil infrastructure and export channels, Washington aims to protect the dollar's primacy in global energy markets and counter rival influences, particularly from China and Russia. In the immediate aftermath, the White House announced plans to market and sell Venezuelan crude indefinitely, including up to 50 million barrels of previously blocked oil, channeling revenues through U.S.-held accounts and inviting U.S. energy firms to invest in rebuilding Venezuela's fractured industry. This pivot, from punitive sanctions to structural economic engagement, is designed to alter not just Venezuelan oil flows, but the broader dynamics of how oil trade interacts with U.S. financial power. Sanctions adjustments and signals of possible collaboration with institutions like the IMF and World Bank suggest Washington sees economic integration as a tool of influence as potent as military strength. However, major oil companies have responded cautiously, pointing to Venezuela's legal uncertainties and infrastructure challenges as barriers to rapid investment. What makes this intervention consequential is not merely who controls oil fields, but how it reframes the geopolitics of energy, currency, and power at a moment when the petrodollar's dominance is being questioned and the very architecture of global finance is under strain. Imagine a world where oil isn't priced in dollars, where instead it's traded in yuan, rupees, or even a BRICS block currency. That's no longer a hypothetical. For decades, the petrodollar system anchored global energy markets to the U.S. dollar, reinforcing its primacy in finance and trade. But that status quo now faces mounting pressure as nations explore alternatives like the petroyuan and other regional currencies, reshaping the geoeconomic chessboard. China's launch of yuan-denominated oil futures, the so-called petroyuan, represents a strategic attempt to internationalize its currency and chip away at dollar dominance in energy trade. Under this system, oil can be priced and settled in yuan, giving buyers and sellers an option beyond dollars and forging deeper financial links across Asia, Russia, and parts of the global south. Analysts see this as part of a broader de-dollarization push among major economies that prefer reduced dependence on U.S. currency systems. The BRICS nations, including Brazil, Russia, India, China, and South Africa, have openly discussed mechanisms to reduce reliance on the dollar, even exploring regional payment systems and joint trade invoicing outside dollar rails. This reflects a multipolar shift in global finance that, while not yet dethroning the petrodollar, introduces fragmentation and choice into oil pricing structures once dominated by a single currency. If this trend continues, even gradually, the implications could be profound. Reduced demand for dollars in oil trade could diminish U.S. leverage over global capital flows, tighten room for deficit financing without inflationary pressure, and accelerate currency diversification by central banks worldwide. In the long run, the energy money nexus that defined the 20th century may yield to a more pluralistic financial order, where the oil price no longer dictates dollar dominance in every barrel. The recent geopolitical shockwaves involving Venezuela didn't just make headlines, they rippled through markets, igniting volatility, speculative positioning, and asset repricing. In the immediate aftermath of the U.S. intervention and capture of President Maduro, oil prices climbed modestly but remained volatile as traders balanced supply expectations with geopolitical risk. Brent and WTI benchmarks edged up around 1%, but uncertainty over tangible production increases kept prices from spiking dramatically. On Wall Street and global equity markets, the narrative was more bullish. U.S. energy stocks surged as investors anticipated future access to Venezuela's massive reserves. Chevron, Halliburton, and other oil service providers posted notable gains. Broad indices, including the Dow, hit record highs as energy and financial sectors led the rally. Yet beneath these headlines lie contrasts between short-term winners and deeper structural risks. Hedge funds that had accumulated defaulted Venezuelan government and PDVSA bonds profited as those assets jumped sharply on optimism around debt restructuring and renewed U.S. engagement. These opportunistic gains stand in stark contrast to the broader volatility faced by everyday markets influenced by geopolitical uncertainty. Safe haven assets like gold and silver also attracted inflows as geopolitical risk intensified, reflecting investor caution amid broader macroeconomic shifts. Meanwhile, currency markets showed resilience. The dollar remained stable, even as debates over de-dollarization and alternative pricing systems gained public attention. In the longer term, the erosion of the petrodollar system, should it continue, could affect capital flows, interest rates, and reserve currency compositions globally. Reduced reliance on the dollar for oil trade may force shifts into diversified reserve holdings and alter how central banks manage foreign exchange portfolios. That kind of transition would benefit investors positioned for diversification, but also pose risks of fragmentation, uncertainty, and higher hedging costs across international financial markets, as historical trends in currency evolution suggest. As the petrodollar system shows signs of strain, the broader macro risks and geopolitical dominoes come into sharp focus, and the stakes go far beyond oil markets. For decades, U.S. dominance in global finance rested on the dollar's role as the reserve currency and the petrodollar's link to oil trade. That framework helped stabilize international payments and supported deep liquidity, but it also created significant vulnerabilities as countries increasingly resist reliance on a single hegemonic currency. If more nations diversify away from the dollar in trade, reserves, and energy pricing, economic fragmentation could accelerate, reshaping the global financial landscape in unpredictable ways. We're already witnessing the early contours of this shift. Major economies, including members of BRICS and other emerging markets, are actively exploring mechanisms to reduce dollar dependence, whether through bilateral swap lines, local currency corridors, or alternative payment infrastructures. China's push toward the petroyuan and the growing acceptance of non-dollar settlement systems reflect a broader multipolar currency competition, not just among states, but across entire regional blocs. Such movements aren't about a sudden collapse of the dollar, but rather a gradual reconfiguration where multiple currencies play meaningful roles in global trade and finance. What does this mean for sanctions? Historically, one of the most potent tools of U.S. geopolitical leverage. As more countries build alternative financial rails and reserve strategies that diminish the dollar's exclusivity, the efficacy of U.S. sanctions could weaken, prompting Washington to double down or innovate new forms of economic coercion. That, in turn, could push more nations to accelerate their de-dollarization strategies, creating feedback loops of fragmentation in capital flows, reserve holdings, and trade networks. The biggest question now is this: will the petrodollar survive the next decade? Or are we heading toward a world of regional financial ecosystems, where dollar dominance persists in some corridors while others operate increasingly outside its orbit? The answer will shape not only currency markets, but the very architecture of global economic power. From the dusty oil fields of the 1970s to the geopolitical flashpoints of today, the story of the petrodollar has been nothing short of world-shaping. What began as a clever marriage of oil and U.S. currency after the collapse of Bretton Woods became the backbone of the global financial system, granting Washington enormous leverage over trade, reserves, and geopolitics. But as we've traced, through Venezuela's rise and collapse, alternative currency experiments, and strategic contests, that backbone may be under strain like never before. The recent U.S. intervention in Venezuela, capturing leadership, seizing oil infrastructure, and repositioning export flows, is a stark reminder that energy, money, and power remain inseparably linked. At the same time, the growing interest in currency alternatives like the petroyuan and regional trade systems reflects a fundamental push toward a more multipolar financial era. These movements aren't merely academic. They influence portfolio strategies, central bank reserves, and the very credibility of sanctions regimes. So we return to the central question that has guided this journey. Is the petrodollar ending, evolving, or simply being defended more aggressively than ever? The truth is, all three may be partially correct. Economies and policymakers are hedging their bets, experimenting with new structures while still relying on the deep liquidity and network effects of the dollar system. What's clear is that the next decade will be decisive, not just for oil and currency markets, but for global power balances writ large. As viewers, analysts, and curious minds watching these shifts, it's not enough to accept simple narratives of decline or dominance. The real picture lies in the interplay of policy, markets, and geopolitics, and in the choices that nations and institutions make as they navigate a world in transition. Stay informed, ask the hard questions, and don't assume the rules of global finance are static, because in 21st century geopolitics, money, oil, and power are still the ultimate trio shaping our future.